All right, welcome back to the deep dive. Today, get ready because we're jumping into the fascinating and sometimes, yeah, surprisingly tricky world of financial statements that look forward, not backward.
That's right.
Our mission for you today is simple. We want to cut through all the jargon. We're going to unravel what it really means when a company shows you its financial future or, when an accountant gives it that stamp of approval.
And by the end, you should know exactly what those different stamps actually signify for you, the person using that information.
So, where are we getting our insights from today?
Well, our sources really dig into the different kinds of jobs, let's call them engagements,
Yeah.
that accountants do around financial reporting. Everything from very specific agreed-upon tasks right into full-blown examinations.
Okay.
And we'll focus on the really crucial differences, especially when we're talking about stuff that hasn't happened yet, that forward-looking information. It's got its own rules.
Right. Okay. Setting the stage.
Right.
Most people, when they think financial statements, they think history, right?
Yeah.
What has happened? Past sales, past profits.
Standard stuff, yeah.
But what about what might happen? That's where the real crystal ball gazing comes in, I guess. Introduce us to this idea of prospective statements.
Sure. So, yeah, most are historical. That's what audits usually cover.
Hmm.
But prospective financial statements are all about the future. They're based on, projections, estimates, not actual past events,
So purely forward-looking.
mostly. They could actually cover a period that's already started, so it's partially expired, but never one that's completely finished. Because, well, then it's just historical data again.
Okay, that makes sense. But then I hear pro forma statements thrown around, and honestly, my head starts spinning a little. How are those different?
Ah, yeah, that's a super common mix-up. Pro forma statements are not prospective. Not in the same way. They're more like a what if using past data.
A what-ish on the past. How does that work?
Well, they show how a hypothetical event, maybe a big merger or selling off part of the company, would have changed the historical results if it had happened earlier.
Ah, okay. So it's like if we'd done that deal last year, our books would have looked like this.
Exactly that.
Yeah.
It's adjusting the past for a potential future change, not really predicting the future itself. And they're based completely on management's assumptions about that what if.
Got it.
And they absolutely must be labeled clearly as pro forma, so nobody confuses them with, actual history or a forecast.
Hmm.
Interestingly, these pro forma statements can be examined or reviewed by an accountant, unlike some other forward-looking info.
Okay, clear distinction. Then what about these partial presentations? They sound, well, partial.
They are, by design, actually. They're a type of prospective information, but they deliberately leave out some key pieces you'd normally expect, like maybe total sales or net income or big financial position changes,
Why would they do that?
usually for specific reasons, for specific audiences. But because they don't show the whole picture, they're generally not okay for general use. You wouldn't just hand them out to any potential investor.
Right, because people wouldn't have the full context.
Precisely. They're more for limited audiences who understand what's missing and why.
Okay, so moving beyond partials, let's talk about the full picture of the future. You mentioned there are two main types of these prospective statements.
Yes, two key types. And their names sound similar, but they mean very different things. First up is the financial forecast.
Forecast. Okay, like a weather forecast.
Kind of. It's management's best guess, their genuine expectation. It reflects the expected financial results based on what they see as expected conditions and their expected courses of action.
So this is them saying, based on everything we know and plan, this is what we honestly think will happen.
That's the idea. Management, or whoever the responsible party is putting forward their most likely scenario.
Okay, so if forecast is the best guess, what's the other one? The financial projection.
Right. The projection is the true what if. It's based on hypothetical assumptions.
Hypothetical, meaning things that might not actually happen.
Exactly. It explores scenarios based on specific conditions that might be unusual or aren't necessarily expected to occur. Like, what if we successfully launch this totally new product and grab 20% market share right away?
Ah, so it's exploring possibilities, not predicting likelihoods.
Precisely. It's showing what could happen if those specific, maybe optimistic or just different assumptions come true.
And this distinction matters a lot for who gets to see these, right? The whole use thing.
Absolutely critical. For general use, meaning, statements for people not directly negotiating with the company, like public investors reading an annual report, only a financial forecast is appropriate.
Why only forecasts?
Well, it makes sense, right? The general public needs to see management's actual best guess, their expected outcome, not some hypothetical what-if scenario that might be confusing without context.
Okay. But for limited use, the rules change.
They do. Limited use means the statements are just for the company itself or for parties negotiating directly with them. Think uh, trying to get a bank loan or submitting info to a regulator or just for internal planning.
So people who are closer to the situation.
Exactly. And in those limited use cases, both forecasts and projections are okay.
Where's the difference there?
Because those users, the bank or the regulator, are usually more sophisticated. They can talk directly to management, ask tough questions about those hypothetical assumptions in a projection, and really understand the context. They're not just passively reading a report.
Got it. So the type of statement depends on who's looking and why. Now, let's bring the accountants back in. When they get involved with these future-looking statements, what can they actually do?
Okay, so there are basically four main ways a practitioner and accountant can engage with prospective financial statements.
4 ways. Lay them out for us.
You've got preparation, compilation, examination, and agreed upon procedures.
Okay. Preparation, compilation, examination, AUP.
Right. And here's a super important point. A review of prospective financial statements. Not allowed. Just those four.
No reviews. Got it. So
Yep.
let's take them one by one. Preparation. What's that about?
Preparation is pretty much what it sounds like. The accountant actually helps create the prospective statements. Maybe for a smaller company that needs help putting together its first forecast.
So they're helping build it. Are there rules for that?
Oh, yeah. The guidance comes from something called SR's Statements on Standards for Accounting and Review Services. It's the rule book, and there are key restrictions.
Like what?
Well, an accountant shouldn't prepare these if they leave out a summary of the significant assumptions. That's crucial context. And for a projection, specifically, they can't prepare it if it doesn't clearly identify those what-if hypothetical assumptions or state the limitations on its use. Transparency is key.
Okay, makes sense. So that's preparation. What about compilation? I feel like this one gets confused easily.
It really does. A compilation's main job is just assembling the financial data properly, based on what management assumes. It's about presentation, making sure it looks right according to accounting guidelines.
So they're not checking the assumptions themselves?
Not really verifying them. No. Think of it like organizing data someone else gave you. They'll read the statements, look for any assumptions that seem obviously wrong or inappropriate on their face.
Like assuming 1,000% growth with no explanation.
Exactly. Something that just jumps out.
Yeah.
But they aren't required to go digging for evidence to support the assumptions. And here's a key thing. The accountant performing a compilation doesn't even need to be independent.
Really, no independence needed.
Not required. But if they aren't independent, they absolutely must say so very clearly in their report, usually in a separate paragraph.
So what does that compilation report actually tell the user then?
It provides no assurance at all. Zero. It doesn't say the statements follow AICPA guidelines or that the assumptions are reasonable. The report will explicitly state that management is responsible, that the accountant did not examine or review, and that they do not express an opinion, a conclusion, nor provide any assurance.
Lots of disclaimers.
Absolutely. It'll also warn that the forecasted results may not be achieved and say the accountant has no responsibility to update the report later on. It's basically saying, we put this together based on their numbers, but don't rely on us for its accuracy.
Okay, so compilation is presentation, not validation. What about examination? That sounds more serious.
It is much more serious. An examination is the highest level of service for prospective statements. Here, the accountant expresses an opinion.
An opinion on what?
Two key things. One, whether the statements are presented correctly according to those AICPA guidelines. And two, and this is crucial, whether the underlying assumptions provide a reasonable basis for the forecast or projection.
Reasonable basis.
Right.
So they are digging into the assumptions now.
Oh, yes. They have to. They need to gather sufficient evidence to support their opinion. They evaluate how the statements were prepared, the support behind the numbers, the whole presentation. They need to get reasonable assurance, which is a high level of confidence, though not absolute certainty.
And for this level, independence is a must, I assume.
Absolutely required. You can't give an objective opinion if you're not independent.
So the examination report sounds very different.
Completely. It will say, we have examined,
Yeah.
and our responsibility is to express an opinion. It talks about obtaining reasonable assurance. And the key phrase is something like, in our opinion, the forecast is presented fairly, and the underlying assumptions provide a reasonable basis.
That sounds much stronger.
It is. It still includes the warning that results might not be achieved because it's still the future. But that opinion on the assumptions is the core difference. Of course, the opinion isn't always clean.
What do you mean?
Well, the accountant might issue a qualified opinion or even an adverse opinion if, say, the guidelines weren't followed or assumptions aren't reasonable, or they might disclaim an opinion if their work was severely limited.
Okay, so examination, opinion, and reasonable assurance. That leaves the fourth one. Agreed upon procedures or AUP?
Right. AUPs are. Well, they're different again. We should probably unpack this one a bit more.
Yeah, let's do that. So what exactly is an agreed upon procedures engagement?
Okay, so in an AUP engagement, the accountant performs very specific procedures that the client has asked for on some specific subject matter. And then this is key, they just report the findings.
Just the findings, no opinion.
No opinion, no conclusion, no assurance on the subject matter as a whole. They basically say, you asked us to do X, Y, and Z. Here's what we found when we did X, Y, and Z. That's it.
Like a factual report on specific tests?
Exactly. And the general rules for AUPs apply here too. But for prospective financial statements specifically, there's an extra condition. The statements must include that summary of significant assumptions we talked about.
Now, you mentioned the client asks for the procedures. Does that mean the client decides what gets checked?
Yes, and this is a really interesting and critical point. The client or the engaging party is responsible for deciding if the procedures they've asked for are sufficient for their own purposes. The accountant doesn't make that judgment call.
So the accountant does what they're told, basically, and reports back.
In a nutshell, yes, as long as the procedures are appropriate and measurable. There's actually a handy mnemonic our sources mention to remember the conditions for performing an AUP. I am sure.
I am sure. Okay, break that down for us.
Okay. I is for independence. The accountant must be independent.
Makes sense for objective findings.
A is for agreement of the parties. Everyone needs to agree up front on exactly what procedures will be done, what criteria will be used, any materiality levels, etc. M is for measurability and consistency. The subject matter has to be measurable, and the findings should be consistent. You need objective criteria.
Got it.
S is for sufficiency of the procedures. And remember, sufficiency is the client's responsibility. They decide if the agreed-upon steps are enough for their needs.
Right. The accountant doesn't vouch for the overall sufficiency. You.
U is for use of the report. The report's use can be general, or it might be restricted just to the specific parties involved, depending on the agreement. R is for responsibility for the subject matter. The client, or sometimes a third party, has to be responsible for whatever is being tested.
And E.
E is for engagements on prospective financial statements. This just reminds us that for AUPs on prospective info, you must include that summary of significant assumptions.
I am sure that's actually pretty helpful. So what does the AUP report itself look like?
It will always have independent in the title. It clearly identifies who hired the accountant, the subject matter, the purpose. Crucially, it states that the engaging party acknowledged the procedures were appropriate for their purpose.
So it puts the onus back on the client.
Exactly. And you'll see strong limiting language like, this report may not be suitable for any other purpose, and reminding users they are responsible for deciding if the procedures fit their specific needs.
And then it just lists the procedures and findings.
Yep. Detailed list. We did this, we found that, no opinion, no conclusion, and it states clearly that no examination or review is done, so don't mistake it for one.
Okay, so pulling this all together, these different engagements offer wildly different levels of comfort, don't they?
Absolutely. Let's recap the assurance levels. Compilation gives you no assurance at all. It's just assembly.
Right.
Examination gives you an opinion that highest level of reasonable assurance on the statements and the assumptions.
The gold standard for prospective info.
Pretty much. And agreed upon procedures gives you no opinion or conclusion on the whole thing, just specific factual findings from the procedures performed.
And independence tracks with that, right? Required for examination and AUPs, where you need objectivity for an opinion or findings.
Correct. But not required for compilation, although it has to be disclosed if lacking. The scope is also totally different. Examination is broad, looking at the whole picture for an opinion. Compilation is narrow, just assembly. AUP is laser-focused on whatever the client specified.
So why do these distinctions matter so much to, someone listening to this?
Well, think about it from a practical standpoint. If you're a bank considering a big loan based on a company's future projections,
You'd want an examination, right? You need that high assurance, that opinion on the assumptions.
almost certainly, you want an independent expert to say, yes, these assumptions seem reasonable, but What if you just need one specific thing checked quickly? Like, does the company have enough cash projected next month to make this one specific payment?
Then maybe an AUP would be faster and cheaper. Just check that one thing.
Exactly. An agreed upon procedures report could be perfect, very targeted. And if a company is just doing internal planning or maybe negotiating with a partner who understands their business inside and out,
A compilation might be enough just to get the numbers organized clearly.
could be. It's all about matching the level of scrutiny and assurance to the specific need and the user. The name on that report, Compilation Examination AUP, tells you a huge amount about how much weight you can or should place on the information inside.
It really forces you as the user to think about what kind of validation you actually need.
Which leads to a really important question for anyone using financial info. Are you getting the right level of assurance for your needs? And maybe more importantly, are you really reading the report to understand what the accountant actually did and what level of comfort they're actually providing? Don't just glance at the numbers.
Wise words. Okay, so that wraps up our deep dive into the sometimes murky waters of looking ahead in finance. We've hit agreed upon procedures, prospective statements, forecasts versus projections, and those tricky pro forma statements.
And we've seen the different ways accountants get involved, from just preparing the numbers to giving a full opinion, and the huge difference between reporting findings and actually giving assurance.
So here's something to chew on.
Given all these nuances we've unpacked, think about how carefully you actually read the fine print, the accountant's report, the disclaimers on financial statements you see, especially the ones about the future. What assumptions are you making when you read them, just based on seeing numbers on a page? And how much trust should you really be placing?
A great question to ponder. Hopefully you all feel a little bit more, well, I'm sure, about what these reports truly mean. Thanks for joining us on the deep dive.